I was reading an article in Forbes this week that Nike is like on top of their game in terms of the whole, sports apparel, athletic wear industry. Adidas is second, but not even that close behind. Like from what I was reading in Forbes, there seems to be a gap. Like Nike is just pulling way ahead of everybody. And I've been reading more and more about this stuff lately, and mainly from the perspective of trying to gain more and more of an understanding of what works, what makes a business successful. When you look at these companies, what are they doing that's making them succeed, that's making them do so much better than their competition, let's just say. And it kind of, when you start thinking about things that way, and I'm reading about this stuff with, that sort of pair of glasses on, it's interesting. Things take on an interesting spin. And so I'm sort of fascinated by this right now. I'm very focused on really kind of studying this, both in big business like Nike and also, how that sort of translates in smaller business. What makes a business really successful? Matthew is on the live Facebook feed, and he says, with all the gifts you are going to buy me, Seth, the market will be up this year. How do you know, Matthew? I might be buying things on the black market for you. Where is Matthew? Why isn't he with us in the live panel? Anyway, today we're talking about equity, right? Speaking of what makes a business successful, a lot of us focus on what? The profit, right? Oh my God, Erica's with us. She's watching live on Facebook. Good morning, Erica. A lot of us focus on the profit, right? And we look only at profits to see what makes this company successful. And that might be an indication of whether the company is successful sort of in the short term, right? But we're looking for indications of whether or not a company is going to be able to maintain, whether they're going to be able to continue to be successful. Does the company have enough cash on their balance sheet so that they'll be positioned to take advantage of opportunities when they arise? Right? Because you could have a lot of profit and still have no cash. And in cases like that, you're very likely in trouble, right? That's why it's so important to understand the statement of cash flows. That's why it's so important to go beyond the basics of bookkeeping and really start taking a look at and learning how to understand ratios and how to analyze them, right? How liquid is this company? How able are they to take advantage of opportunities when they come up? If they needed to, could they settle all their debt tomorrow? Right? Do they have enough in short-term current assets to satisfy their short-term current liabilities if they needed to? And how many times over, right? Regardless of the industry, we usually want to see a balance sheet where the current or better yet, the quick ratio is at least 2, right? We want to know that we could settle those obligations twice over if we needed to. That means we have enough cash to function and to run and to do the things we need. And when it comes to investing in companies or trying to understand things from the perspective of those who might invest in a company. And I'm using the term invest broadly. It could be somebody who's looking to actually invest, such as somebody who wants to own a piece of the company, or it could be a bank who's considering lending money to that company. And the bank's only concern in those cases is to make sure they can get paid back, right? So this is why I think it's really, look, we have Linda twice. But this is why I think it's really important to, to understand and to really take a look at this stuff, to understand the equity section, how to structure it so that it can be really useful when we're reading the balance sheet. So that's what I want to take a look at with everyone today. And Matthew, good morning. How are you? Exactly. All right. Thank you for sharing. Greg,
he was up when I got up at 6:30 this morning, my time.
Nice.
Emailing me.
Was he up or had he just not gone to sleep?
Exactly.
Oh.
Good to see everybody. Happy Friday.
Happy Friday. By the way, before I really dig in, and let me just check something here real quick. Okay. We're very close to the end of the road on the Bulletproof Bookkeeping course coupon code. September 30th, it expires. The coupon code is Bulletproof Books. Make a note of it. Make sure you take advantage of it because it's set to automatically expire at midnight on September 30th, which is like Monday or something, isn't it?
Yep.
So do it. Just do it.
Am I the only one who can't stop staring at the balloons going all over the place in the background?
Yes, that's only you.
Okay.
It's kind of fun. I can do that all day, right? Anyway, how about some equity? Who wants equity? Hopefully you all follow that up with a question. What am I getting equity in? Right?
I don't care what kind of equity I'm getting. I would like to have some, please.
Dog poop. I'm giving you equity in dog poop.
We'll figure out what to do with it.
So I have a special place for all of you here.
And the dogs bark on cue.
Speaking of dog poop. Somebody needs to go out. So the first thing I want to talk about is how I like to set this up in the chart of accounts. Now I want everybody to pay very careful attention here to what I've done in the chart of accounts. If I go down to the equity section, we have Matthew Fulton Capital as the parent equity account, right? I have shareholder.
It's empty.
What?
It's empty.
It is for now, but we're going to fill it up. Don't you
That's
worry.
because you're in jail for disorderly conduct.
We have shareholder capital, then we have contributions, and then we have distributions. Okay, and the term shareholder obviously refers to the fact that we're assuming this is a corporation. So I just want to be clear that the nomenclature that's used here is going to change based on the entity type. But other than that, everything else remains exactly the same. So we have an LLC where you would have members. We have a partnership where it would be partner. So you just replace the word shareholder with whatever the appropriate term is. If it's a sole proprietor, then it's just owner, right? Then it's just owner capital, owner contributions, owner distributions, right? Other than that, the structure is exactly the same. Now, the main reason for the three, these two should be very straightforward. Contributions are for when Matthew puts money into the company, and distributions are for when he sucks the company dry and takes all the equity out. Right?
I don't have any clients that do that.
What?
I said, I don't have any clients that do that.
I'm sure, but it's a good idea. Oh, you mean that take distributions? I thought you
That
meant
suck all the money out of the company.
Yeah, exactly. Well, and it's interesting because, one of the first conversations I like to have with a new client coming in the door is in terms of what's their long-term strategy, right? If they don't want to sell the company, if this is their retirement plan and they're going to retire on it and just let the business rest when they're ready to retire, then fine, take all the equity out. Doesn't really matter. But if you have any intention of selling, or if you have any inkling that you might at some point want some kind of funding or investor, then really the strategy needs to be building the equity section.
But
right?
they're just borrowing the money.
What are you talking about?
They're going to put it back, they always say, right?
Yeah, of course they are. Of course they are. So one of the things I've said in the past, like especially when Mike McCallich's book Profit First, has really made the rounds over the years, I've often thought about writing a book called Equity First, right? Or maybe equity second, right? Because really, to build equity, the first thing you need is profits. Because sure, you can build equity by contributing money into the business, but that's not useful, right? And a quick look at the statement of cash flows will show you where that money is coming from, that it's not coming from operations. And ultimately, a healthy company is one that can build equity by taking cash from operations, primarily from earning a profit, but then most importantly, retaining those profits, right? And what we're going to do is I'm going to add in another equity section for another shareholder, right? We're going to make Linda a partner in the company, okay? Because then that's going to give better context for what this particular account is all about at the end of the day. All right, so let's get Linda set up in here real quick. I'm going to say new, and we're going to say equity.
I'm taking all the money.
I was going to say, I bet she ended up with all the equity.
The shoes.
So I'm going to say shareholder capital, Linda Ardesani. Okay, and save and new. Okay, I wish it would just leave the prior settings when you hit save and new on that. And then this is going to be shareholder. Oh, what did I do? I missed something. Anyway, this is going to be contributions. Save and new. Equity. This is going to be distributions. Okay, and then we're going to bring them all under the parent account that we want, right? So where did you go, Linda? There she is. So this is Seth David Capital. Wait, where did Matthew go?
I took all the money.
Oh, no, it was.
Order.
No, it's all over the place. Okay, so we have Matthew Fulton Capital, and then we have shareholder capital. That's how I did it. And notice what I'm doing here is I'm checking how I set it up because I want to be 1,000% consistent. That's very, very important because what you're creating here is something that people are going to want to be able to read on the financial statements. And if I'm not very consistent with the nomenclature and how I structure even the wording, you know, like if I'm making the parent account of each shareholders equity section based on their name and then the word capital, that's what I need to do for each one, right? It sounds OCD and overly detailed, but it's so important because somebody's going to be looking at this on the balance sheet and it needs to make sense, and it needs to make sense quickly. And if you're not consistent about things like this, it confuses the reader of the financials. So it may sound like I'm being, what's the word, pedantic here, but I promise you I'm not. I promise you this is extremely important. So we're going to create one more equity account.
Allow me to be even more pedantic, and you've got your detail type also.
Yeah. Well, and I've been doing that, if you notice. In each case, I've just been doing partners equity on that. So this is going to be Linda Artisani Capital. And save and close, and then I will. So now notice Linda's name is in all of these accounts, which makes the filter work really well. Again, that's something I've thought about. And now I'm going to edit each of these and make them sub-accounts of Linda Artisani Capital, right? So we're going to go edit. And I like copying and pasting something like this so that A, it saves time, but also there's that much less of a chance that I accidentally pick one of these other accounts as the parent account. It's just one of those dumb little things that saves me the trouble of messing something up. And one more time, edit. Okay, so now I've got it structured perfectly, and if I type capital in the filter, not all the accounts have the word capital, right? But I can see I've got Linda Artisani Capital and then her shareholder capital. I can see Matthew Fulton Capital and his shareholder capital, and Seth David Capital and my shareholder capital, right? Do you see how consistent that is? That's so important to me when you're setting up your chart of accounts. And by the way, this I think slightly underscores another reason why I'm not in love with using like a standard chart of accounts. A lot of people I see will say, hey, do you have a standard chart of accounts for this industry or that industry? And my answer is always no, because every chart of accounts is going to be a little different. And I really, for me, I prefer to take the time to construct each customer or client's chart of accounts with a lot of intention around this, right? Just making sure that I create what I need as I need it, instead of, I feel like when we pull in a template chart of accounts, you end up with like a dumping ground and just with a lot of garbage in there that we don't really need, and it actually creates confusion. I almost always start with a pretty much blank chart of accounts, and then I create what I need as I need it. And that first conversation I have with a new client is the one in which we're going to talk about what's your structure, what kind of a company do you have. We're going to talk about what the goals are. We're going to find out what's really important to the client to track, and that conversation is going to drive a lot of how I structure this, right? And the first thing I do in almost every case, if it's an existing client, then I just go to the equity section of their chart of accounts and see if I need to reconstruct it. Almost every time I do, because almost every case when I take over a client's set of books, it's clear that nobody's paid attention to this. I remember taking over a client early this year, And, you know, another bookkeeper had been working on their books. Obviously, they came to me because it wasn't working well. And within the first like month of banking that I was putting together, I had already had the conversation with them, but the client even failed to mention to me that there was another member in the LLC. And what happened was, as I was going through their books, I saw a large deposit come in, and he said, oh, that was from like a line of credit from my wife, or something having to do with his wife. And so that sparked a new conversation, which revealed very important information that had not been revealed to me previously, even though I had asked. A lot of times the clients just don't know what they don't know. And so it turns out that he and his wife were both members individually in the LLC with their own percentage of ownership, right? And that's the other thing that's going to be really important to know when you're working on a client's books is who are the owners and what's their percentage of ownership, right? Now, in this case, I have 3 of us as shareholders, myself, Matthew, and Linda, right? Let's just assume we're all 33% owners, right? So we're all equal owners. Let's go run a report. I want to see, this was the company file we used last week. I want to see what the profit looks like on these books so far. So we actually have a loss of $603.50, right? Let's say that this was our loss for the year. Let's say that this is January 1st, 2020, and the 2019 books show the books are closed. We're all done. Everything's posted, all the depreciation. There's nothing else to book. We're literally ready to set the closing date on the books. So this is the final number on the net income for the year. This needs to be divided 3 ways between Linda, Matthew, and myself, and it needs to go into our respective capital accounts. So let's duplicate this and look at the balance sheet. This is the key, and a lot of people on YouTube, I have videos, you know, covering the equity part and year-end closing, and a lot of people ask me about posting a closing entry for the year. And the what do you call it? You know, the answer I often have for people is there's really nothing to do if you have a single owner in a company and there's no equity to divide up amongst the partners or shareholders or members or whatever they are. Then there's really not much to do. QuickBooks will automatically post the closing entry and take the net income that's in the current year and close it out to retained earnings, right? It'll do that automatically. But when we have a situation like I'm describing here where there's 3 equal shareholders, we don't want that just going into retained earnings. What we need to do is divide this up 3 ways into each of our capital accounts. Notice you don't see the capital accounts here because there's nothing in them yet, right? So that's what we want to do is we want to take the 60350 and divide it up. So what I'm going to do, because I'm not good with math, is I'm going to open up a blank spreadsheet, and I'm going to take 60350 and divide it by 3 to see how much
201.17. Well, 201.16. You can give Linda the extra penny.
Well,
negative.
Linda will get the extra penny to go to her shoes.
Yeah.
Well, keep in mind this is a loss, right? So she's going to have to return some shoes.
I know. That's why I gave it to Linda.
All right, so 201.17, and as you point out, when we add that back, it's not going to divide up evenly, perfectly. So let's prepare the entry, though, and I'm going to go do a journal entry. Okay, and so what we're going to do is we're going to, it's a loss, right? So the increase, of course, is going to retained earnings to cover the loss. So that's going to be the 60350. There's a credit to retained earnings. And since we're reducing our equity because we're dividing a loss amongst us, the debit has to go to each of our capital accounts, right? And that's what those capital accounts are all about. So Linda's shareholder capital. So that's the whole purpose of this, of the capital account within that structure, is to divide up income and losses and track that cumulatively. Okay, and then so we're going to go with Matthew, and we'll get his capital account, and then we'll go with me and my capital account, right? And we said it was 201.17.
2 people with 201.17, 1 with 201.16.
All right, well, we said, all right, I'll take the 201.16. I'll take the advantage. Right? So when I save this, let's go back to the balance sheet because that's where the action's really happening here. We're going to see this balance sheet populate. What's the effective date here? This is 2019.
Change the date. Change your date to 1/1/20.
Yeah, I'll just post this on to 12/31 of 2019, right? I like to do it on the last day. I guess we could do it on the first day of the next year. Yeah, that's a good point, Greg. January 1st is really the best day to do it because January 1st is New Year's Day. Most businesses don't operate, so there really shouldn't be any other activity on that first day of the year, which means it's a great day to reserve for entries like this, where you're doing kind of year-end adjustment type entries.
That
Right?
also makes it really easy when you pull a balance sheet for the prior year versus the next year. You can make sure these adjustments are done correctly because you haven't impacted the rest of the balance sheet.
Right. All right, and I'm just going to put a memo here saying distribute earnings between capital accounts.
Is this a good reason to use the adjusting journal entry?
You know, I've never messed with this. I'm going to be very honest here. I probably should know what the difference really is, but I honestly don't. I never mess with it. I
They
think
just
it's
pull up in
supposed to.
different reports that way.
Yeah, it probably is because an adjusting journal entry, I believe, does normally refer to the kinds of entries like your CPA would do on the books for year-end type stuff, just like this, right? And by the way, if you're a bookkeeper and you've gotten accustomed to dealing with, and let's face it, there's a lot of this out there, a condescending tax preparing professional who thinks because you're a bookkeeper you don't know what the heck you're doing. Start doing this stuff, and that will turn around very quickly. They'll start to have a lot of respect for you and the fact that, hey, this person really does know what they're doing. This and doing my trial balance adjustment to force the books to agree to the last tax return that was filed. When you start doing stuff like that, what you're really doing is you're really helping that CPA or enrolled agent out, because the first thing they're going to do when they look at a set of books that you've worked on is check, or the first thing they should do is check the equity section of the balance sheet for the last year that was filed and compare that with the tax return that was filed, and they want to make sure retained earnings ties. And the minute it doesn't, they start to lose confidence quickly. And then their arms go up because they're like, oh, God, I have to fix these books. And really, all they want to be able to do is prepare this return so they can move on to the next one. Mm-hmm. And I'm doing a lot of reading now and learning more and more about how we have to change our perception, first of all, of who our clients are. Right, your client may be the company whose books you're preparing, but in many ways, the person preparing the returns for that same company is also, by extension, your client. And the reason I've mentioned this recently in my emails that I send out every week, the reason I'm back to using the word client is because, as distinguished from the word customer, a customer is just somebody who pays you for a product or service. A client is defined as somebody who's under your protection, right? And so how are you protecting your customer and the person who's preparing the returns? You're protecting that CPA or enrolled agent's time, which is very valuable to them, by helping them out by doing stuff like this in order to prepare for year end, right? You're protecting your client from the additional billing, which is probably at a much higher rate that the CPA or enrolled agent would need to charge to do this kind of work. If you've already done it at your rate, it saves your client money. Right. And I've been reading more and more and just changing my perspective on these things and learning that, you know, when it comes to what it really means to have somebody under your protection, you're either protecting them from some kind of harm or pain of some sort, but you're also removing obstacles from them. From your client standpoint, you're protecting them from the pain of getting a big bill from whoever's preparing their taxes. From the CPA or enrolled agent who's doing their taxes, you're protecting them from the obstacle of having to spend the time on doing this when really what they want to do is just get the return filed because they have 800 returns to file, right? So all of that was to explain why this is really good for you if you're a bookkeeper to learn how to do. And there's no reason each and every one of you can't learn how to do this. The most complicated thing we did was divide a number by 3 and then figure out where to adjust the 1 penny to make sure the entry balanced, right? There was nothing more complicated than that. If you're a bookkeeper, obviously you should already know your debits and credits. So that part of this should have been pretty straightforward, right? We have a loss, so we need to increase the equity. Credits increase equity. And we have the distributions of that loss, which have to reduce equity accounts. So those are the debits to the capital accounts. Alexa's in the chat. She says, I have trouble getting CPAs to give me the balance sheet adjusting journal entries for sole proprietors. That's probably because there's no balance sheet on a Schedule C on a sole proprietor's tax return, so they don't know why you care. But all you have to do, what I would do is just press them and say, I care. Or if I really feel like the CPA enrolled agent isn't cooperating, what I'll do is I'll go to the client and say, hey, I've been asking your CPA for such and such. They're not responding to me. Can you please go? When the client who's paying them goes and says, hey, my bookkeeper needs this, they're asking for it, why aren't you giving it to them? that's going to push the right button. That's going to make them take action because they don't want an unhappy client, especially over something as trivial as just send the damn entries, right? It's not that hard.
I had a CPA tell a client that they didn't know what an adjusted journal entry is.
Nice.
So after 2 years, finally, I convinced the client to get rid of the CPA. The CPA would be on the phone. It's like, I have no idea what you're talking about.
That's hilarious. That's hilarious. All right, let's save this and see what this entry.
The only time I've had issues with the CPA, not that it's issues, is that if there's a scope creep that happens with the client, and so they may push back on something because they may not have included that as part of their plan. And that's understandable on one level, sort of like making it clear what it is that they are providing service-wise. That's the only thing I've had.
It only makes it more difficult the next year when I turn over the books.
Yeah, I don't see why providing.
If I don't have their AGEs in there, my books are never going to match, and they got to go figure out why they're not matching to the tax return from last year.
I guess on this one, it was more of just maybe it just depends on. Sometimes the client is kind of pushing; they get more sensitive to any request. But
I don't see how providing information that should naturally be provided anyway would encroach upon any kind of scope creep. I mean, to me, that's ridiculous, honestly.
Yeah. And I'm not necessarily meaning it in respect to that specific request, but that's my experience when they've gotten pushback. And it wasn't pushback, like they just were sort of like, okay, I can get it to you.
Right.
This is somebody that I have a good relationship with, but I just sort of realized that what he bought into a practice, and when he bought into it, things were sort of ballooning on him a little bit. So he was having to manage that piece of things for himself.
Right. And look, at the end of the day, if you can't get the person who prepared the taxes to cooperate and send you the entries, you can always derive those entries by doing my whole trial balance process. All you need is the final tax return that was filed, and you can derive from that what the trial balance was, and then compare that with the QuickBooks trial balance. And I have my whole template that walks you through how to do that process, so that even if you don't have the entries, you don't necessarily need them. All you really need is the tax return, and you can figure out the entries to get the books to agree as of a certain date, right? So in the worst case, if for some reason you just can't get somebody to provide you with the entries, all you need is the final tax return, which they have to provide to the client, which means the client has no excuse for why they can't provide that to you. And then you just use that. It might take a little more time to get it done, but it's important. It's important to sort of preserve the integrity of the books that you have, right?
Which, to add on to that real quickly, is why it is so important that if you haven't actually made that book to tax adjustment, that you close the period so no historical information is modified. Because when you go to do your book to tax, you're trying to do it based off of what you gave them, that snapshot at that time of what the numbers were and what they have to be adjusted to match the book to tax.
Right.
So that's a really important reason why you need to close that period, especially if you haven't made that adjustment.
Yep. And it should be a red flag if somebody says, hey, I need you to release that lock. The first thing you should do is ask, why? What are you changing? Like, that's sacred. You can't change that stuff. Can
you tell me the password so I can open the books?
Right. Alexa, if you have a client, sole prop or otherwise, who says they don't want to give you their 1040, I would say, I'm sorry, I can't work with you then. I mean, how on earth could somebody in their right minds hire you to do their bookkeeping and then tell you they don't want to give you their 1040? If they're a sole prop. I mean, I get possibly that they're concerned about the sort of privacy of their personal tax return, but sorry, if you want somebody to prepare your books and you're a sole proprietor, you need to provide the 1040. Right. There is, I think can't you set the actual date of the closing? So you can do a month or a year end, right? Unless you're saying you would want a year end and then separate from that a month end close. But I would just, whatever the most recent date is that needs to be closed, that's the date you would use. So if last month is done, just use last month as the closing date. But I think well, anyway.
I think she might be referring to closing out the equity.
No, she's saying she wants two dates to use. One would be the year end saying this year is closed, and then a separate closing date for the most.
That's actually a good idea.
It would be a really cool feature, actually. But in the meantime, the workaround obviously is just use the most recent of those two dates that you would need as the closing date, obviously.
I know this is a little bit of a side tangent, but it's directly related. All third-party applications, when the books are closed inside QuickBooks Online, They do not have the ability to go back beyond that. So if you ever run into an issue that if the period's closed, which is a big challenge because of what we're talking about with an app, it could be part of it.
And you have to close it with the password. If you just close it with the warning, then the app can still go in there and dick with it.
Right. Now, by the way, I just forwarded the date of the balance sheet to the 1st of next year so that you could see the impact of the entry that we did. So notice everybody's capital accounts is here. But let's go back to being pedantic again, because you see what happened.
What's the date on that, though? That says September 27th.
Well,
That's just the day the report ran.
Yeah, that's just the day
you did it for 1/1, okay.
Yeah, I just
scroll down again then.
Yeah, so I just went in and forwarded the date of the balance sheet to the 1st of next year, which was the date I posted that entry on, right? But one thing you can see is my capital account is sort of separate from Linda and Matthew's because in between we've got opening balance, equity, and retained earnings. So let's fix that real quick.
Zach, can I stop you for just a second?
Sure.
Your cash flow buddy, Mike Milan, is now joined Facebook.
Okay. Hi, Mike Milan.
I still think his last name is Million. It just sounds good. Cashflow Mike should be Mike Million.
It's actually Mike Milan. When I first called him Mike Milan, he said, I'm not that sophisticated. I'm more of a redneck. Those were his words, not mine. Anyway, so back to here. What I want to do now is I have, these different sections, right?
Combine them under one.
Yeah, exactly. I'm going to create a new parent equity account and just call it like shareholder capital as a general.
Another way that it might work, which I've done, is if you just start off with capital hyphen and then the name of the person, then you also can have them all lined up together.
That'll work until I've got something else that somehow falls in between. I prefer to group them for that reason specifically. Because I played around with, you can put an underscore in front of them and that will put them together, but it just ends up getting in the way of the other things. This is a sure way to get them grouped and structured exactly the way we want, which is why I do it. So this is shareholder capital for everyone. Let's save and close. And then all I have to do is take each of these groups at the parent level and make it a sub of that. So let's go edit. And this is going to go under shareholder capital. Crap, I've got too many shareholder things now.
I mean, this is a great system here until you start getting like, hey, there's 10 owners. 15 owners. You know, I mean, my largest client just went through Series B. They've raised 40 million and they've got 30 different owners in there. And it's like, I've never seen this done. So I'm kind of sitting there mind blown considering they get audited every year. And, and so I'm like, oh yeah, why don't we do it? I'm like, oh yeah. Why would
By the way, Jake, sounds like a good reason to use QuickBooks Online Advanced because that chart account's going to be pretty big, man.
Oh, Jesus Christ. It's the whole reason I don't want advanced. I don't want that big of a balance sheet. But at the end of the day, if you have the detail either on tax returns or like,
well, especially when you
I just never sat there and said, hey, geez, do you need to see the breakout of every owner? Especially, if you had 10 owners, would you do this? Does it make sense?
I think you would. I think having 10 owners would be more reason why you needed to do this, right? Because you really need to. Here's a classic example. Look, you could consolidate this by just having one capital account for each shareholder, right? And then you could always drill into the details and divide things up, but it makes it much harder to see. What this does is it makes, even though that section of the balance sheet might start to get long with a lot of owners, it still makes it so crystal clear. Here's their cumulative share of the earnings based on their ownership percentage. Here's what they've contributed. Here's what they've taken out, and it all totals up beautifully in the equity section of the balance sheet. So if I'm a banker or an investor coming in and looking at this company, I'm like, holy cow, whoever's preparing these books is doing a really solid job of making it really easy to read those financials, which means when the books are under scrutiny, I'm immediately going to be that much less inclined, or I'll be less inclined to scrutinize the books, right? Because it will give me confidence right away that somebody who's preparing these books is really taking care and paying attention to how the books are kept, right? It's clearly very important. And the other thing is the classic example, and I learned this the hard way years ago. If this were an S-corp, What I didn't know for a long time was that each S-corp shareholder's equity account needs to be maintained in exact proportion to their percentage of ownership in that company. So if I have two 50-50 S-corp shareholders and one has net distributions, let's call it, of 50,000 and the other one who has net distributions of 100,000, I've got a problem. Those two need to be equal because they're 50-50 shareholders. When I learned this, what I did was I went to the two shareholders. They were brothers, actually. And I said to the guy who had taken out more, I said, do you want to put money back into the company? He said, no. I went to the other brother, said, do you want to take more money out of the company? He said, no. So then what I did was the one who had taken more out of the company, I reclassed the difference to a loan. But that's hardly bulletproof. That is just a Band-Aid. And anybody who knows how to read a balance sheet could see right through that. But it was what I had to do because the brothers didn't want to sort of cooperate any other way. And so that's what we did, is we reclassed the difference to a loan and just moved it to a different spot on the balance sheet.
This is mind-boggling to me because I've never had a CPA ever say anything to me about this, and I have plenty of C-corps out there with multiple owners.
Yeah.
And I get the theory behind it. I mean, I'd hate to have to do it and, there's adjustments. But I get it. I just am surprised knowing it's like, hey, along with my AGE, is the AGE to separate out retained earnings to the individual owners based on the proportion of their ownership. You know?
A lot of people, I think, don't do it or they don't care, right? But like I said, this was specifically with an S-corp where this one particular case, their CPA, and they had just taken on a new CPA. The prior CPA never said anything, but this CPA obviously was really detailed about things. And when they looked at their balance sheet, they questioned me on it. And I was honest with them. I said, I had no idea that that was a requirement. And they said it absolutely is a requirement of S-corps. And what you're always running into, the sort of danger that we're trying to protect our S-corp owner clients from, is that if you're not careful about how you handle things like distributions and what's going on in the equity section, and especially as that compares with their cumulative net income. If they've taken out more in distributions than their cumulative share of net income, they could potentially be subject to capital gains tax. And that can be hefty. So that's where, and this is why, by the way, it's really important and very helpful and useful to know these things, to do your homework and understand all these implications. So it's just, again, it's just really important. I'm looking in the chat. Brad says, why not just manage equity section offline? Not a fan of such a busy equity section. Well, that creates a disconnect when I'm trying to present these financials to a potential creditor or investor. That's why. That's
especially in this scenario. So one other thing to take into consideration is generally if you're going for funding like that, you're going to have preferred stock and common stock as well that you have to deal with. And if now the beauty of a C-corp, if you're really doing it that way, is that's a whole different structure to it. And you don't necessarily, you're not going to have every owner listed out from that aspect because they just have shares of the corporation, right? So that's a whole different aspect of how it would be done also.
So this would only really be done then, Linda. Now for S-corps then?
The breakout like that, right?
I would be inclined to do this for anybody because the other, look at an LLC where you have members, and especially where the members, and their member agreement is where you're going to find the percentage of ownership that each member has, and you want to make sure that this is maintained, especially the distribution of the net income. I'm inclined to say do it for everyone. At the end of the day, you could leave this account out of it, and you could consolidate the contributions and distributions into a single account, meaning each shareholder would have a single equity account, and all of the activity would be lumped in there. But it just means it's that much harder when the time comes for scrutiny of any kind. I have to drill into the details and divide it up some other way and probably dump that into a spreadsheet and do some work on it to explain to somebody, what's going on in the equity section. Again, and it goes back.
Some apps out there that specifically handle the equity splits that would connect as well. So there are some apps that do it, but I agree, you're still having to go outside of a program when it comes time for financials, and that never goes back into a report easily without extra customization.
Right. And Brad's saying you can still present the equity details in a different schedule that ties back. Again, that's another disconnect, though, which leaves questions open potentially. It's so much easier in my experience, and I've been through these kinds of things. I'm not just talking out of where. It's so much better when you can simply present the balance sheet to somebody and say, here it is, and it's all here and it's all clear. I don't need supporting schedules. I don't need to go outside. It's just all laid out beautifully, crystal clear on the balance sheet. But again, it goes back to having that original conversation with the client and understanding what their objectives are. If the client isn't concerned with being overly detailed on the financials because all they're doing is running this business until they retire and then they're shutting down, or maybe the only potential stakeholder they're concerned about is their kid that they're going to hand the business off to, then this doesn't matter. Then just do the one equity section. But keep it in mind, if you have two or more unrelated owners, then this probably starts to matter, because it's all fine and good until the day comes that there's a dispute among the owners and they don't agree on the numbers that you've presented them. And then, again, it's fine. Sure, you can do supporting schedules. You can track it in spreadsheets. But anytime you start with a disconnect like that, to me, it creates more work when the time comes that you need it, which ultimately opens you up to more scrutiny. And it may be that you have perfect support for it and you can explain it all, but you're still going to need to spend the time explaining and justifying your numbers. And I think it can be avoided by just being a little extra detailed right here. That's all. That is my story.
Equity section is very, very complicated and confusing. It's been something that has taken me a long time just to get to the understanding I'm at. And I feel like my knowledge is like that, right? There's just so many part of it's the different variations, right? Whether it's a partnership, everything else, the terminology that's used can be very scary. Yep.
And Brad, I want to go back to Brad's comment in the chat. He's comparing this to being overly detailed in the fixed asset section. And the comments are valid and fair. I'm not disputing that. But the reason I think this is very different and why that's not a fair comparison at all is the fixed asset section could forever grow. This doesn't grow like that. The only time this grows is if I add another owner into the mix, right? And that doesn't usually happen too often. Usually once this is set up, you have the same owner mix in perpetuity. It's very rare you have a lot of turnover of ownership in a company. So pretty much if I have the 3 shareholders, as in this example, it's going to stay that way. It's not going to keep expanding the way of fixed assets.
Plus, wouldn't those fixed assets, in a sense, be divided, if necessary, amongst the different owners? The value, you know what I mean? Like, you're muted, Seth. Or you're...
I think Seth, your microphone died. That happened to him a couple weeks ago as well.
I should clarify, I don't mean like it's actually like you take and divide it out. I just mean that if you're looking at the balance sheet and the way it trickles down, if the cash equivalent and everything else.
Crazy on the gator.
Oh.
Okay, can you guys hear me now?
Yep.
All right. So what I was saying is I don't know that I would. I don't think, again, the fixed assets is a whole different ball of wax. Obviously, fixed assets, you group assets into asset categories, like what's furniture and fixtures and what's equipment. And the distinction generally is based on how they're going to be depreciated, right? The asset groupings in the fixed asset section is, you group the same kinds of assets together because they're probably going to have the same basis for depreciation. I think it's a totally different ballgame. I mean, and look, like Brad himself said in the Facebook feed, to each his own, whatever works for you. I agree. What I'm trying to do here is speak from my experience. It's not conjecture, it's from my actual experience about what I find works really well. And it goes back to the points that I've already made about when I'm presenting financials to somebody, my goal is to minimize the amount of scrutiny that those financials will be placed under. The more questions I can eliminate before they can be asked, the easier that process is always going to go when it comes to presenting those financials to that banker or potential investor who's there to protect themselves and make sure that these financial statements present a fair picture of the company that they're looking at, right? And so to me, the fewer questions I need to answer along those lines because I've presented really solid bulletproof financials, the better it goes for me. Because what usually happens is the minute any doubt is raised on the part of the person scrutinizing those financials, that's when the can of worms opens up. As soon as there's a little bit of a doubt, there becomes a lot of doubt. And then I have to spend a lot of time proving everything. Because, look, I used to be an auditor. I know what it's like from that side of it. I know that the minute I saw something that didn't look right, I started increasing the scope of my testing dramatically because I trusted nothing at that point, right? And I'll give you another example along these lines that we were actually looking at something like this a couple of weeks ago when I was doing, as I've been doing this series on how cash flows. And I used the example of how 2 different ways to record the commission that was paid out of a customer payment, right? And I said you could take that deduction right out of the deposit and post it to the commission's expense account, right? And that works. It's absolutely correct, and it's definitely a more efficient way to do it. And the reason I said I prefer the other method where you would actually separate the transactions, right, where you would have the whole deposit in there, and then the deduction from the deposit wouldn't go directly to the expense. It would be taken out through accounts payable to pay off a bill. And here's why, from an audit standpoint, that was really important to me, is if I'm an auditor and I'm auditing that commission's expense account and I'm looking at a list of transactions, and in that type column, I see bill, 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 expense, 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 deposit, guess which transaction gets my attention and raises doubt, right? This is my point. It's in most cases, most of the time, this level of detail is not going to be that important to you for most of your clients. But when you have a client that is likely to be under scrutiny because they either want to sell their company or they want a major amount of investment in their company, whatever it is, this is the level that I like to go to. This is what I call bulletproof. And to me, that's the difference between bulletproof and compliance. Compliance means it's not wrong, it's okay. But bulletproof means there is practically no question about these books and whether or not they're put together accurately and fairly and free of errors, right? And omissions and those kinds of things.
This might be a little bit of a rookie question, but is it possible to use the products and services in order to track the owners? Like, you could run a report through a product service, and I don't know if I don't think you can use them in journal entries, so maybe that won't work if you're trying to do journal entries to assign things over. But I'm just kind of curious if that would even be a possibility to keep the chart of accounts smaller.
No, if you're going to go that route, then I would go with what Brad's saying in Facebook and just track it outside. You can use Airtable, you can use a spreadsheet, you can use Smartsheet. There's lots of tools out there that can be used outside of QuickBooks Online to track it. And I just want to be clear, I'm not saying that what Brad is suggesting is wrong. It just creates one disconnect, right? So now I have to go from what the books say to what the supporting schedule says, and now I have to have the conversation with the person scrutinizing the books and explain, I have this supporting schedule to minimize clutter on the chart of accounts, which they'll understand, but it's just one more thing I have to explain and one more thing that might raise doubt. Whereas in my experience, if it's all laid out crystal clear, like I'm showing you here today, there'll be no question. The only question might be if they want to scrutinize if I'm doing the distribution of the income and losses each year properly. That's very easy to drill into the numbers, though, when it's done this way and confirm. All I have to do is run a P&L for the period and then go into the equity sections in each of those capital accounts to show that there should be one entry per year there, nothing more, right, just for the distribution of the earnings that I can clearly show is the appropriate portion of the net income for the applicable year, right? In other words, it's very easy to put the audit trail together for that. As soon as I go outside, I'm not saying you can't or shouldn't, or it's wrong to do that. I'm just saying it's going to result in extra scrutiny when the time comes. And if you can avoid it, you should. If it's truly too much for you to have all that on the balance sheet, I get it, then do what you got to do. But what I'm trying to explain to people here in the biggest picture is the difference between what I would call bulletproof versus compliance. And to me, what I've shown you here today is bulletproof, right? Anything else would be compliance, which again, compliance is not wrong. It's just not bulletproof. It's not quite as solid. It means there's extra things to do to connect the dots on what I'm presenting in those financial statements.
Hey, Seth, can I do something real quick?
Absolutely.
Just want to tell my dad happy birthday real quick.
Happy birthday, Mr. Fulton.
So,
Happy birthday.
love you, Dad. Thank you.
Is he watching with us?
No, but I know my mom will tell him to now. So it's one of those things. Sometimes we all get so busy, right? I always want my parents to know that even if I'm busy working, I'm always thinking about them.
Absolutely. Family first, always. Most important thing in the world. And keep in mind that your close friends are God's way of apologizing for some of your family members. Just kidding. I love my family. All of them. Matthew's off the screen.
Jake had learned a lot today. What I learned a lot is, funnily, I was having a conversation with someone who has a company that they're getting investors for, and I wasn't thinking about this complexity of managing that equity piece. I mean, I had it sort of in general terms, but what it means to me is to really think put it towards what fee I would want to charge for it. So I appreciate Jake bringing that up, because yes, you can build it out, but it's just more of, well, if it's not going to be in chart of accounts and you have to manage it outside, there's just a whole nother level of work that needs to be managed. And I just need to factor that. I would need to factor that into what I would propose as a fee for it and justify it in that way. So I learned a lot in just thinking about it from managing a different type of company than I have in the past.
Yep. Yeah. And again, when I've set it up this way for clients, and especially where it really kind of stands out is in cases where I haven't discussed it specifically with the client, and then I present them with the balance sheet. Imagine presenting a balance sheet to a client where you're getting a lot of oohs and ahs because they're like, holy crap, that makes it so clear, how much equity each shareholder or owner or member has in this company. And it also gives them an opportunity to comment on that and say, hey, something doesn't look right. And in my experience, when the business owner says something doesn't look right, they're usually spot on, and usually they may not understand how to drill in and get to the details and find out what's wrong. But I've learned to trust that when my client says something doesn't look right. And a lot of times they immediately say that, or they say that, and then they immediately defer to, but I'm sure you know what you're doing. And I'll say, no, don't do that. If you think something doesn't look right, there's a good chance I've missed something. It very well could be something I couldn't have known about without your help and input. So let's dig into this. Let's drill in. Let's figure it out, right? My favorite and the classic story is, and I've told this a lot lately because I've been sort of so hot on this subject, was the client who said to me, there's no way I took as much out in distributions as what this balance sheet says. And when we drilled in within a few minutes, we ran across a $75,000 distribution check he had written himself. And then he jogged his memory when he saw the big number, and he was like, oh, that's right. I had to pay somebody back. He had borrowed some money prior to that from someone, and he made a lot of money that year. So he paid the guy back. And I remember joking with him saying, I hope I get so wealthy someday that I can forget about a $75,000 check I wrote.
Who has not had the conversation at the end of the year where they're like, well, if I made all this money, where'd it go? And then you're like, oh, let me just bring this category up for you on the balance sheet.
Yeah,
oh,
exactly.
Yeah. Oh, yeah, I forgot about that. I didn't take that money out. We've all had that one.
Yep, exactly.
Fish shoes. It was fish shoes.
Yep.
How does the loans from shareholder play into this? I have a client that at the end of every year, the CPA gives a journal entry to post something to loans to shareholders, and I just don't get it, and I just post it and I move along with life.
Well, especially with an S-corp, you'll see that a lot because they're trying to keep the activity out of the equity section for the reasons I was talking about earlier, where the shareholders could otherwise potentially be subject to capital gains tax. Right. So by removing any kind of distribution related activity from the equity section and moving it over to the assets or liabilities, they're in effect avoiding that.
Okay.
You know what, Seth? I want to say that I've seen accountants do that just to adjust the books because they have no idea where to put things.
That's kind of what I'm wondering, because I mean, we're sitting now at a negative $15,000 loan.
Yeah, no, I think some accountants feel they're just more conservative to avoid putting things in the equity section, right? And it also could be that they're trying to keep their job of tying the retained earnings out more easily, right?
Is it just to deal with like basis and in the business? They don't want to go over the basis?
Well, yeah, which goes back to the capital gains question, right? Yeah, if their distributions exceed their basis, that's when you have capital gains potentially. But what I always do is if I don't understand it, especially if I don't like it, I'll question it, and not in a confrontational way. I'll just say, hey, can you help me understand this entry? And especially if I see that year over year we're accumulating a balance in a loan account. The point of a loan account, and as I often like to say, the numbers should tell the right story about what's going on. If I put something in a loan, it should really be to suggest that the intention is for that amount to be repaid, right? And whereas the equity section I view as a more permanent, like if I take money out, I don't plan on putting it back in, right? If I put money in and I call it a contribution instead of a loan, it's because my intention is different. It's that I don't expect that money to be paid back. I expect that to be viewed as my investment in the business, increasing my basis in that business, right? So, and Alexa says there should be interest on the loans, right? It depends. Not necessarily with an S-corp because it's a flow-through entity, so it would be sort of redundant. I would charge my company interest, but then that would be interest income to me. And with an S-corp, it all flows through to my personal return anyway. So, charging interest on a loan from an owner to an S-corp would create redundancy and extra work. A C-corp, different story, because a C-corp pays its own federal taxes, right? So there, you absolutely can charge interest. If you're the only shareholder in the C corp, then again, it might, you could do it. You're just you still have to pick up that interest as income on your personal return, and then of course the interest expense on the C corp's books is a deduction. So you could definitely do it on a C corp. Whether or not you should is probably a question for the person who's doing the tax strategies with that client. S corp, I think it would absolutely be a redundancy to do the interest. And same with any kind of LLC, really, especially a single member LLC, which is a disregarded entity and therefore a flow through just like an S corp. So it really depends on the entity. And again, that's why it's important to have that initial conversation with your client and get a very clear understanding of their structure and all of their intentions before you start putting their books together, because having that knowledge and understanding should actually play a significant role in how you structure their books as you're setting them up. So
maybe a topic for our next session could be talking about the different entity types and especially as we transition from S corp to C corp, because I've got a couple clients that are contemplating switching from S to C or C to S, and I'm out of my depth when it comes to that, and so I would definitely rely on the CPA in that.
Yeah, there's two people who should always be consulted when determining what entity type we're setting up. The tax strategist, which is usually going to be the CPA, and an attorney.
Yeah.
Right? Because the attorney is going to understand it from a legal perspective, and based on the kind of business they're in. Like I know in the state of California, if the nature of the business is owning real estate, we would never do an S corp. We would always do an LLC, and that has a lot to do with California and the rules here, where that could be very different if you're dealing with a company that's buying real estate that's based in Texas or somewhere else, right? So that's why it's really important. That's where it definitely goes beyond the pay grade, I think, of any bookkeeper or basic accountant. And that's why when it comes to entity selection, it's important to consult the person who's doing the tax strategy and the legal professional. You need those two perspectives in helping to understand what's the right entity type. So
I fully agree. So now that they've made that decision to switch from one year being an S corp to the next year being a C corp, how do we effectuate that change in the chart of accounts, in setting up a new set of retained earnings, if that's something that we need to do, so on and so forth, and what have you?
Yeah, well, if you're changing the entity type, there's a good chance there's a new tax ID, which means we need a whole new set of books.
Agreed.
But yeah.
But it doesn't always happen that way.
Right. Yeah, there's going to be a transition period, but then that all has to really go as due to froms between the two entities until you're finally transitioned over. That's usually how I handle that. Because there's going to be that transition period where transactions that really belong to the new entity are being conducted in the old one, right, in the old bank accounts until everything is kind of completely moved over. But yeah, it's a great topic. We'll definitely keep going with this stuff. There seems to be a lot of interest. Teresa is in the Zoom chat saying that she'd like to see more on the cash flow statement. And Teresa, if I remember correctly, I believe you have signed up for the Bulletproof Bookkeeping course. And so along those lines, I will share with you that in that course is a slightly more than 1 hour video deep dive, more extensive than I've ever done anywhere else on the statement of cash flows, going through a series of transactions and actually looking at the impact on all the financial statements, but of course with a heavy emphasis on the statement of cash flows and really understanding at the end of the day how to use that statement to determine what is the financial health of this company? Because I can sort of manipulate things on the balance sheet and the P&L. The statement of cash flows has a way, I like to explain it like this, of removing all the BS from the equation and really cutting things down to brass tacks. Here's the cash flow. Here's what's coming from operations. Here, it eliminates all the non-cash stuff like depreciation, which can, again, skew things. And it reconciles if the statement of cash flows is done in the correct format, which is the indirect format, which certain cloud accounting softwares that I've looked at don't do. But if you have the indirect method of the statement of cash flows, it does a proper reconciliation from accrual basis net income to cash, so that you can very clearly see how we get the answer to the question Linda brought up, which is how do we get from the accrual basis? How do I make all this money and yet I have no cash in the bank? The answer is it's all laid out very clearly in a statement of cash flows, but you got to learn to read the statement of cash flows, which is not necessarily an easy thing to do. So more than 1 hour deep dive on the statement of cash flows in the Bulletproof Bookkeeping course, and a quick reminder and shameless plug that you have until Monday to take advantage of the coupon code, and then the price of the course goes to $1,000. That's all, folks. Don't forget to join Gina's Hangout later today. Join us at, what is it? I always forget now, 2 o'clock Pacific to talk, and then 2:30 to go live. SBAA, Small Business Accounting Advisors, is the group on Facebook. Make sure you join it if you haven't already, and then Gina will guide you into her webinar later today.
Yes, I will. See ya.
Bye.
Bye, y'all.